When most people hear the phrase $8,000 a month from dividends, their mind jumps immediately to one conclusion: you must already be rich. They imagine millionaires shifting money around, sprinkling cash into giant blue-chip companies, or living off investment portfolios that ordinary people could never dream of. But the truth is far more surprising. You don't need to start rich, you don't need a huge salary, and you don't need to gamble on risky stocks or chase the next shiny opportunity. What you really need is a clear system, a long-term mindset, and a few carefully chosen strategies that most people never use because they've convinced themselves that dividend income is only for the wealthy. But that belief traps people in the same loop year after year. Work, earn, spend, repeat. They never take the first step toward breaking that cycle. The moment you understand how dividend income truly scales, the whole idea of you must be rich first begins to fall apart. The first reality people need to understand is that dividend income is not magic. It's math mixed with consistency. It's the result of using time as leverage instead of brute force. When you put your money into the right dividend-paying companies or funds, you are essentially buying tiny machines that print money for you, not in the lottery sense, but in the predictable, measurable, legally obligated sense. Your only job is to acquire more of those machines and let them run long enough for the compounding effect to take over. And the beauty is that even small amounts snowball faster than most people expect. For someone starting from zero, the road might feel slow in the beginning, but the people who reach $8,000 a month are not the ones who had the biggest starting capital. They're the ones who understood the importance of strategy and applied it relentlessly. A surprising number of investors try to copy what they see online without understanding the difference between the strategies behind those portfolios. That's why one person invests $10,000 and earns $200 a year, while another invests the same $10,000 and earns $800 or even $1,000 a year. The difference is structure. Some people chase high-yield stocks and get crushed. Some stick to safe companies but never optimize. Some diversify too much, while others diversify too little. The point is, you cannot hit an $8,000 monthly goal with random choices. You need a plan that includes starting small, increasing contributions over time, using smarter yield combinations, picking dividend growth assets correctly, avoiding the traps that cut your returns, and understanding tax sheltering where possible. Without these steps, the journey becomes 10 times harder. With them, the path becomes clear and shockingly achievable. Imagine you start with nothing but the willingness to invest $100 a month. That seems tiny, almost laughably small compared to the idea of replacing your income with dividends. But that $100 isn't meant to transform your life instantly. It's meant to start the habit. Every investor who eventually earns thousands each month begins with the habit, not the amount. Over the next months or years, you slowly increase your contributions, not dramatically, not painfully, just naturally as income grows or expenses are optimized. This approach removes pressure, removes stress, and removes the overwhelming feeling of comparing yourself to people with much larger portfolios. It's not about matching someone else. It's about establishing upward momentum in your own financial life. Once you begin contributing consistently, the next step is choosing where the money goes. This is where most people make their biggest mistakes. They think high-yield stocks are shortcuts, but high yield is dangerous. Many companies with massive yields are seconds away from cutting those dividends. Others are drowning in debt, shrinking financially, or using dividends as bait. You don't want a company that is slowly dying but throwing out big payouts as a distraction. You want healthy companies with sustainable earnings, reasonable payout ratios, and consistent cash flow. That's why this system focuses on a blend of dividend growth, moderate yield, and stability rather than chasing the highest percentage on the screen. And then comes one of the biggest secrets that very few new investors understand. Dividend growth is more powerful than dividend size. A company paying 2% today but growing dividends 8 to 12% per year will outperform a 6% company that never grows payouts. This is because growing companies increase your income every year automatically. You don't have to buy more shares for your income to rise, and when you reinvest those dividends, the compounding accelerates even faster. This is how small portfolios turn into reliable income machines. The growth silently multiplies in the background while you keep adding new contributions, but not all dividend growth companies are equal. Some have been increasing dividends for decades. These are known as dividend aristocrats or dividend kings. They offer reliability, not the highest returns, but long-term predictability. Others come from rapidly expanding sectors like energy infrastructure, financial services, or industrial technology. These companies may not have 50 years of increases, but they have powerful tailwinds and strong cash flow. The right blend of stability and strategic growth is what creates dependable long-term results. On top of individual companies, many investors rely on ETFs that focus on value stocks, dividend growers, or high-quality income producers. These ETFs are ideal for people who don't want to research or manage dozens of stocks. They provide diversification instantly and reduce the risk of holding a failing company. And some of these ETFs have dividend yields of 3 to 5%, while others lean more toward long-term growth but still provide strong income over time. When you combine these with individual positions that match your personal risk tolerance, you end up with a portfolio capable of scaling toward $8,000 a month, even without a high starting point. But strategies alone won't get you far if you don't understand contribution scaling. If you invest $100 a month forever, you won't reach your goal. But if you go from $100 to $150 to $200 to $300 over a few years, especially as your income grows, the snowball becomes unstoppable. Most people think they need big chunks of money, but the truth is that they need increasing chunks of money. The consistency matters more than the initial size. And if you raise your investment rate every time you get a raise, every time you cut an expense, or every time you redirect money from a finished bill, the compounding accelerates. Instead of relying on luck or random stock performance, you use your own income growth to feed your portfolio's income growth. Another key factor is avoiding the traps that drain your progress. The biggest trap is selling too early. Many investors panic during market drops and sell the stocks that would have made them thousands in the long run. Dividend investing is built for patience. When prices fall, yields rise. When yields rise, you benefit more from reinvesting. And when markets recover, the gains multiply. Another trap is over-diversifying to the point where returns become diluted. If you hold 60 different dividend stocks, your winners get drowned out by your mediocre picks. A concentrated but balanced strategy works better. Perhaps 12 to 20 strong positions combined with a few ETFs. This provides protection without watering down your growth. Then comes the tax optimization factor. Depending on your country, you may have tax advantage accounts where dividends can grow without being taxed. Using these accounts wisely can speed up the journey significantly. Even if you don't have access to these accounts, understanding qualified dividend tax rates, foreign withholding taxes, or the difference between REIT taxation and regular dividends can save you thousands over the years. Taxes are one of the biggest silent killers of wealth, but when you learn the rules, they become one of the biggest amplifiers instead. Alongside tax optimization comes the strategy of reinvesting dividends intelligently. Most dividend investors blindly reinvest into whatever stock paid them, but this isn't always ideal. Instead, many successful investors use a strategy called directed reinvestment. This means they collect the dividends as cash but manually reinvest into whichever of their holdings is currently undervalued or below their buying range. That way, they buy value instead of automatically buying whatever is overpriced. This increases return efficiency dramatically over the years. As your portfolio grows, the psychological side of investing becomes more important. Many people self-sabotage. They get impatient. They see others making faster money with crypto or day trading. They start doubting the process. But dividend investing is not about hitting a jackpot. It's about building a system that pays you reliably whether the economy is booming or crashing. Once you have a strong portfolio, the income becomes incredibly stabilizing. Your money works for you even when you're sleeping, resting, or taking time off. You become less dependent on job income and more confident making decisions in your life. Eventually, once your portfolio reaches significant size, say $150,000, then $300,000, then $500,000, you begin to feel the shift. The income becomes real. It becomes meaningful. It begins covering bills, rent, utilities, vacations, or full living expenses, depending on where you live. And when you finally reach investments above $1 million, something entirely possible over a decade or two of consistent effort, your monthly income can exceed $8,000 while the portfolio continues growing. You don't need to withdraw the principal. You don't need to sell assets. The machine continues working forever. This is why so many financially independent people are obsessed with dividends. It's not the glamour, it's not the excitement, it's freedom. Dividend income is predictable, it is stable, it is defendable, and unlike salary income, it doesn't require you to wake up early or clock in anywhere. It gives you time to work on passions, time to spend with people, time to rebuild your life, time to pursue opportunities you previously couldn't. Time is the real reward. What most people never realize is that the emotional transformation that happens along the journey to earning thousands each month from dividends is just as powerful as the financial transformation. At first, investing feels like a chore, something you do because you're supposed to, something that sits quietly in the background, something you barely notice. But as months turn into years, something shifts. You stop investing out of duty and start investing out of identity. You become the kind of person who thinks long-term, who delays gratification, who sees possibilities others ignore. And this shift doesn't just influence your finances, it influences your confidence, your lifestyle, and even your relationships. People who build dividend portfolios learn patience in a world obsessed with instant results. And ironically, it is this patience that ends up accelerating their wealth far more than any shortcut ever could. There's also a fascinating psychological effect that happens when your dividends begin covering real-life expenses. At first, maybe your monthly dividends pay for your phone bill, then your internet bill, then your groceries. Suddenly, everyday life feels lighter. You no longer look at your bank account with the same sense of scarcity or fear. You don't worry as much about the what-ifs. What if I lose my job? What if something breaks? What if I need a few months off? Because your portfolio begins acting like a protective shield. Every month it puts money in your pocket whether or not your job needs you, whether or not the economy is perfect, whether or not life is going smoothly. The moment you experience this shift, your entire relationship with work changes. You start choosing jobs instead of feeling forced into them. You start negotiating with confidence. You start noticing opportunities you ignored before because you were too busy trying to survive. And something else happens too. Your spending habits evolve. Once you see money turning into passive income, it becomes harder to waste it. Not because you become stingy, but because you become strategic. You stop thinking in terms of price and start thinking in terms of opportunity cost. Instead of saying, "This is $200, your brain starts saying, "This could add $10 of passive income every year for the rest of my life." You begin valuing freedom more than fleeting purchases. And ironically, by valuing freedom, you eventually create the financial space to enjoy those purchases later without guilt, without pressure, without consequences. This is the path dividend investors walk, delayed gratification that evolves into sustainable comfort. The curious thing is that most people don't fail because the journey is hard. They fail because it's slow. They want excitement, drama, spike charts, adrenaline. Dividend investing doesn't give you that. It gives you peace, predictability, and a calm upward slope. But peace doesn't attract attention. The louder parts of the internet tell you to chase the next moonshot, the next crypto surge, the next overnight millionaire formula. And people fall for it because impatience is built into our culture. But the investors who win are the ones who reject that noise. They embrace the boring. They embrace the predictable. They embrace the methodical grind that everyone else underestimates. And when the results finally show, they arrive quietly and permanently, not explosively and temporarily. There's another unseen advantage to dividend investing that rarely gets talked about: resilience. When you own companies that send you checks every quarter, you stop fearing market crashes. In fact, crashes become opportunities. While others panic, you accumulate more shares. When prices fall, yields rise. When yields rise, your income grows faster even if your contributions stay the same. It's the ultimate reversal of financial anxiety. You find yourself rooting for red days because they make you richer in the long run. This mindset separates true investors from casual spectators. Spectators flinch at volatility. Investors thrive on it. But building an $8,000 per month dividend engine doesn't just require consistency, it requires strategic leverage. This means choosing the right balance between yield and growth. High-yield assets give you more income up front. Dividend growth assets give you explosive income later. And stable blue-chip dividend companies give you the reliability needed to anchor the entire portfolio. The magic happens when all three categories work together. The high-yield assets boost your early income and motivation. The dividend growers multiply your income over the years. The stable companies preserve and protect your wealth through economic cycles. This synergy is what turns an ordinary portfolio into an income-producing machine. At some point, usually years into the journey, an investor experiences what I call the compounding moment. It's not when you hit a certain number. It's not when your portfolio looks impressive. It's when your dividends exceed your contributions. Imagine putting in $400 a month while your dividends pay you $450. That is the moment you realize you have created something alive, something that works without you. It's almost spiritual. You feel a switch flip in your mind, and after that moment, your desire to continue becomes automatic. You no longer invest because you have to. You invest because watching your money work is more satisfying than spending it. The last thing people misunderstand is that dividend investing isn't about saving money. It's about redirecting money. Instead of buying upgrades or luxuries that disappear quickly, you put money into assets that pay you back for the rest of your life. The formula transforms your financial identity. You stop thinking like a consumer and start thinking like an owner. Every dollar invested is a dollar that goes to work for you. And the more workers you have, the sooner you reach escape velocity. So the truth is clear. $8,000 monthly dividend income is not about being rich first. It's about building the structure that rich people use, but doing it from the ground up. The plan is available. The math is predictable. The process is slow but inevitable if followed consistently. And the sooner you start, the sooner compounding becomes impossible to stop. The journey begins with your first contribution. The destination is the moment your money works harder than you do. And once you cross that line, the rest of your life will never operate the same way again.